I'm ready. Okay.
Okay, good morning, everybody. I'm going to begin with offering you a breathtaking experience. And I'm going to take your breath away by telling you that you're all going to have to do some math right now. But knowing that we have a person in our membership here who's pretty good at math, I've recruited him to help us all. So if you look at this first slide, this is the cumulative appreciation nationwide since 1991. If you look at Colorado, we led the nation. We're at 574% appreciation since 1991. Now I'm going to ask Gary to do a little math for me based on a couple of simple premises so that we can illustrate what I'm going to talk about. I'm going to say that you bought a house in Boulder, Colorado in 1991, which, believe it or not, was possible. And I'm going to say that over the course of that time, the value appreciated only 525%, not 574% for the sake of simplicity. Take it away. What was your rate of return?
So the down payment was 20,000. The
20,000.
house's value was 100,000.
Correct.
Is that right?
That's correct.
And so at the time of sale, it got sold for around 500 and X.
525.
525,000. So even if we subtract off the initial total investment, which would be 100,000, you have to take off. We're looking for what's the net gross gain without taking other factors into account. We got about 425,000 of return, and we put 20 grand in to begin with, and we're looking at something around a 2,100%, 2,200% increase. Now that leaves out a couple of factors, but that's a very gross look at it.
So let me chunk that down a little bit. Your investment really was not 100,000. Your investment was 20,000.
Yeah.
So if you say that you made $425,000 on a $20,000 investment, that's a 2,150% return. Let that sink in as we move on to the next thing I want to talk about here, which is, I mean, we can look at what it was just in the most recent year. Well, in 5 years. In 5 years in the state of Colorado, we saw increases of 58.55%. Same math, Platt, and just in 5 years. One of the best investments you can make in your life, I think everybody can agree, because not only do you get that kind of return on your investment, but you also get to live there, paint the walls whatever color you want, put in new lighting fixtures, build a little fence around the backyard, and put your puppy out there. So now going on, I want to talk about a couple of other things, and let me get this one open. This is a presentation of historic interest rates, right? What interest rates have been. And I'm going to stop and just say, everybody, I sent you all of this material via email, so if you want to refer to it, you have it. I brought a few today to refer. If you look at that, it wouldn't be immediately obvious, but the median interest rate over this period of time is 7.5%. So we are below historic norms right now. A couple of things I'll point out is every single one of these spikes you see preceded a recession. What do you notice down here at the right-hand corner of the page?
Breaking downtrend and the next first horizontal resistance, and it's about to go higher.
Well, the interest rate?
I'm reading the chart.
Oh, okay. Well, what I would tell you, what we're talking about is a recession starting. Okay, not technical analysis.
Well, I thought you were bringing us our attention to the bottom right of the chart.
Thank you. Yes,
Sorry about that.
could be true. Actually, I'll contest that in a minute. But
Okay.
So in any event, we're likely to go into a recession. What always happens in recessions is the Fed starts printing money and pumping it out. You'll remember helicopter Ben Bernanke, just spreading the wealth everywhere, except it only went to wealthy people. So that's going to happen again, particularly since we're in an election cycle, and the last thing the Fed wants to be concerned with is having been thought to have influenced an election outcome in any way. So I'm calling, me personally, but everybody I know that's in macroeconomics is also calling for a recession and that same outcome. Now, if we go on, you might ask yourself, what is the cost of waiting? If you can buy, are you making an emotional decision or a rational decision? Because the good Lord gave us two ways to make decisions. He gave us our heart, which leads us to make about 98% of our decisions, and He gave us a brain to conduct a rational process and arrive at a rational decision. Most of us make our housing decisions using our heart. Oh, it's beautiful. I can just see us living here. Or I'm afraid to buy right now because I'm seeing all these talking heads on TV that are pumping poison into me. But if you look at it, and this particular illustration is designed to consider a first-time home buyer, which I'm going to come to in a minute, with all of the programs that are available to you that make it really easy to buy. So I'm just made some assumptions. $500,000 house, you're going to do a $12,500 down payment, which I'm going to come back to in a minute. So your loan amount would be $487,500. Interest rate today is right around 7%. In this CHAFA program, interest rates on FHA loans are a little bit higher than they would be if you just came to me and got an FHA loan. So your principal and interest would be $3193.45. I said, but what if you could have had 5% today? Just thinking about, well, I'm waiting for 5%. I've got some magic number in my head that I think will make me go out and buy a house. Well, if you do a little math there, you discover that the annual difference between the principal and interest payments on that on those two loans is $7,400. And then you come down and we see the sales price. I just use a 4% appreciation rate, even though in Colorado we've seen as much as 21% in a single year. And I say that that's going to be $20,000. I subtract the difference in the payment. You're still money ahead by $12,595 if you bought today, even with the higher mortgage payment. Now, in this particular program, if you use the CHAFA financing, I'm going to offer you a second mortgage that's 4% of the loan amount, which turns out to be more than your down payment. So not only are you going to get into the house with nothing down, but you'll have a few bucks for the new fridge and some beer and donuts to put in it. So that's example number one. Now, example number two, just kind of let me stop. Well, I'll come to questions in a minute. This is another illustration. You know, I think there's a math error on that first one. No, I guess that's about right. Cost of waiting. This is going to go out and buy your home in Boulder, right? Or make it Broomfield or Arvada or Fort Lupton now with a $750 purchase price. Again, we're going to do a down payment in this case of 20%. This is a real deal. You can buy. You've got good income. You're living in an apartment, but you're thinking, I'm going to wait till that magic interest rate arrives of 5%, because in your lifetime, the highest interest rates you've ever seen are probably 5%. In mine, I was back there in that 1982 number when they were 21%, okay? But this, now we're working towards that magic number of 5%. Is that going to stop me from buying the house? No. $750 sales price, $150 down payment, loan amount $600,000. Interest rate today is probably 6 1/8%, 30-year fixed versus 5%. The difference in the payment over a course of a year is $4,000. The appreciation at 4% on that is $30,000. When we subtract the difference in the payment of $4,077, you will be missing out on $26,000 in capital gain if you don't buy today. Okay? So again, it's a rational process, not an emotional process, a struggle. There are several programs now that I can tell you about. that help first-time home buyers. The government's all about getting everybody into their home. And they've come up with these programs to get people in their homes. There are two, they're very similar, as offered by Fannie Mae and Freddie Mac. We're going to talk about the Freddie Mac one's called. Does anybody not, have you not heard the terms Fannie Mae or Freddie Mac? Anybody here? Okay, I'll assume you have then. They're the two big agencies that buy like 95% of all the mortgages produced in the United States. One is Home One and one is Home Possible. In the first case, it's designed, and they're both first-time homebuyer programs. In the one case, if you live in a geographic area which is identified as being eligible for this program, and if you are a first-time home buyer, and if your income is no more than 80% of the area median income for that particular area, you're eligible for this program. With this program, it's 3% down. You can use down payment assistance. You can get these forgivable second mortgages. You can get grants. You can get help from your family. So basically, you can get into it with no down payment. Then to make it sweeter, the government waives all of the adjustments to the price of the mortgage. That is, how many points you pay to get a particular interest rate, so that it's flat. You actually pay less adjustments to the price than you would if some guy working for Google making $500,000 a year went out and bought a house, you know, with 40% down and excellent income. He's going to pay more in price adjustments than you would on this program. Price adjustments are measured in points, or 1% of the loan amount, or some fraction thereof. The monthly mortgage insurance, you have to have mortgage insurance because you're putting so little down. The lender perceives more risk if you put less than 20% down. So they require that they be indemnified against the loss that might result from a default on the loan. So mortgage insurance is required, but they offer it at a very low rate relative to what would normally be the case if you're only putting 3% down. So everything is being done here to make this as easy to slip into as you can. The other program is very similar, but there are no geographic requirements. There are no income requirements. You can make 250% of the area median income, which, by the way, in Boulder County is right around, I think, $93,000, something like that. Depends on how many in your family unit and so forth. You still get those great price adjustments. You still get a very favorable mortgage insurance rate. You can still use down payment assistance, but you don't get the lowest mortgage insurance rates. So those are two programs. And then those are here, Home One, Home Possible. And you can read the differences there if you want to. Now, CHAFA, I didn't put anything in here really, I don't think. Let's see. Did I? No, I didn't put anything in here, so I'll just describe CHAFA to you. Colorado Housing Finance Authority, you can look it up online if you want to. Colorado Housing Finance Authority is an agency that's set up in the state of Colorado to help make housing more affordable in Colorado. It takes federal funds, it works with a lot of different lenders. Principally, if you get a CHAFA loan, it's going to be an FHA loan. FHA then sets the guidelines for underwriting, and oh, by the way, on all of these programs, you do have to qualify. In other words, you have to have sufficient income to qualify for the mortgage. So it's going to be an FHA loan, and then CHAFA itself offers grants, outright grants, and it offers assistance in the form of what's called a silent second, and that's that 4% I was talking about earlier. So your down payment's 3.5%, but this help coming from CHAFA is 4%, which is more than your down payment. And we'll only be talking about the silent seconds because none of us here would qualify for the one that comes in the form of a grant. So the silent second is simply a second mortgage that's closed at the time of the first mortgage. However, there's no payment on it, it bears no interest, and the only requirement is that you pay it off when you refinance or you sell the home. So it just sits there. We don't calculate the payment or any interest on the second mortgage. We only look at the payment on your first mortgage. And so it makes it easier to qualify. And these loans have helped a lot of people that just haven't managed to garner a few bucks to make the down payment. Well, that's the whirlwind introduction to first-time home buyers. I'm prepared to take questions. Yes,
I'm going
sir.
to make a comment.
Okay.
You know, to me, the biggest advantage, it's so hard for people to look way downstream and save. And buying a home forces you into that principal and interest investment. And a lot of young home buyers, when they come to the end of their life, the amount of equity that they have is found in that home that they purchased. And we're terrible at percentages and odds, and we hate present pain and future benefit. And so the thing about buying a home, I think, is that it puts you in that a kind of a forced saving. It doesn't mean it's the greatest investment in the world, but it does cause you to put money somewhere and save it.
I'll add to that for anybody who's renting, you'll know this, but the increase in the cost of renting has been going up right along with the increase in the cost of everything else. And in some areas in Colorado, it's actually cheaper to own a home than it is to rent a home. Just as an aside. Kate, you had your hand up.
Yes, good presentation. Liked it a lot. I think it's important that first-time home buyers would understand that sometimes you can come to the table. I helped a couple who they had been chronic renters and they didn't have any savings, and we got them into a CHAFA program. They actually got the grant. They showed up at closing with $500 to buy their first home. 5 years later, they've had better jobs, they've accumulated money, etc., and they've leveraged that first home, that little stopping point in the house that wasn't like their forever home, into one that they really love now. And so just even making that first step can happen to get you to where you really want to go.
You remind me of a key piece of this that I forgot to put in, which is that cost of waiting chart. If you make the assumption that you're going to have to wait 2 years for you to be able to refinance to a much lower rate than 6 1/8 or 7th, I think you're making a correct assumption. So you gain the equity during that 2 years, you refinance, now you got the best of both worlds, you got an extra $50,000 worth of equity, and your rate's not 6 1/8, it's 4 7/8 or 4 1/2 or whatever, which means now your cost to carry is much, much lower. So just remember, interest rates are not permanent. They go up and down every day, every single heartbeat, but over a course of time, you will have an opportunity to get lower rates. If you go back to that chart from the Federal Reserve Bank showing the kind of the path, the trend of mortgage interest rates, it's been steadily down since the Carter years. Yes,
Hey,
Dave.
Jim.
Would you consider your house a liability?
Hold on, Chris.
A liability?
Yeah.
Never. There was only one period of time, and that was in 2008, and I don't really have time to get on all of the underlying economics, when some people found that their home was worth less than what they owed on it. At that point, that is a liability, okay? But that was a rare, and rare to the extent of totally unique circumstance in the last 65 years of our history.
So you consider it an asset?
Absolutely. I consider well, to be specific, I consider your equity in the home to be an asset.
Gotcha.
I heard Chris, I think.
Yeah, Jim, I have a question. Look, I know you're a shrinking violet when it comes to giving your opinions, but I'm just curious, where do you think interest rates are going right now?
Down. I think the Fed's probably going to pause here. Just it's just my opinion, but I follow a lot of. I don't watch CNBC. I take my news on macroeconomics from people that really know what they're talking about. And so, the Fed, as I mentioned, we're going into an election year cycle. Every single time this has happened, they've done what I just described, which is they've either held rates steady or taken rates down so not to be perceived as having any influence on the election. Of course, that helps the incumbent. We would rather see them spike them again, personally, but, oh wait, that's my opinion. Anybody else?
I don't have a question, but I would like to give a testimonial to Jim. When I first joined TRP 10 years ago, I was financially in a bind, and Jim redid my loan and got me in a much better position. But then 5 years later, when the interest rates came down, he got me an even better loan. Also wiped out both my car payments and my credit card debt at the same time. And we borrowed a little bit of extra, but it got my monthly payment down to just one thing instead of, four things. And then right before COVID hit, we went into a reverse mortgage and got me to an even better position. And thank God, because during COVID, I lost my two bread and butter clients that I'd had for over 20 years, and it seriously affected my cash flow. And so Jim has really saved my bacon more than once. So.
Thank you. I appreciate it. I was happy to be there to help.
Jim, do you ever have parents use these programs and buy investment properties for their kids? Like, because if you can buy one time with almost nothing down.
Well, no, this is for the person who is going to be the owner occupant.
Right, so if
And
it
the
goes
owner.
in the child's name.
Well, if you can have a co-borrower, that's correct. The person who's going to occupy the property has to be the borrower.
Oh,
Okay.
So not right.
So the parent can't treat it as an investment property. But I do have programs for investment properties, 25% down, still do it. I'll say briefly too, there might be those in the room that still have student loans. If you do, there are programs where you can include your student loans in the mortgage. And since the student loan forgiveness thing is just done, it's done at this point. People will have to start paying back their student loans, and that might be helpful.
I did that, and I got a $20,000 student loan wrapped into my home during a recession, and it really saved my bacon.
Yep, it works a lot. So there are some programs out there. Any other questions or
I have
any
a
other?
comment, Jim.
Yeah.
There's a noisy group who say debt is terrible, stay the hell away from debt, get rid of debt as fast as you can, pay off your mortgage as fast as you can. And all of the young people I knew, when the interest rates were 2.5%, 3%, 2.75, that get a 30-year fixed mortgage if you're planning on staying in that home, and pay it off as slow as you can, because inflation is going to outpace your interest rate. And so that whole business of what type of loan, variable interest and fixed interest and length of term, and how, if debt is sometimes not harmful, it's beneficial.
To that point, I recently did a loan for someone. And what they didn't realize was that their $78,000 worth of credit card debt was killing them. But they were reluctant to refinance because they had a 3 3/8% first mortgage. We did it at 6 1/8. The new first mortgage rolled all that credit card debt in there. They saved $1,425 a month in cash flow, which means they had, plenty for extra beer and donuts. All the credit card debt went away. But I said, if you'll just simply pay an extra $1,000 a month on your mortgage, you'll pay it off in 12 years quicker than you would have done with the original mortgage.
Yeah.
So a lot of it is just being rational about it, thinking about it, factually moving out of the emotional realm to make a good decision.
Great presentation.
Hey,
Others?
Mike, just real
Yes.
quick. Also an endorsement for Jim. Jim helped me with a mortgage a couple years ago. And, technically, I guess a lot of people could do a mortgage. The advice that Jim was able to give me and the way we were able to sit around and talk, like you just explained, helping somebody with a big credit card debt, that was much more valuable than him just getting me a mortgage. So really, really encourage you guys, if y'all are looking for a mortgage, I would rather, I won't go with anybody else other than Jim as long as he's in the business.
Thank you so
Absolutely.
much.
Yeah.
Okay, everybody, take that deep breath. I'll give you your breath back.
Very good. Thank you, Jim.
Uh-huh.
Thanks, Jim.
Thanks, Jim.
Hey, Chris, there's something up with your microphone.